SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Let me welcome you to the SUERF BAFFI Bocconi Meet the Author webinar series. Today's event is inspired by a remarkable new book by Barry Eichengreen, Money Beyond Borders. It's been published by Princeton University Press earlier this year. And the book offers a sweeping 2,500-year history of international currencies. Eichengreen puts the dollar's prospects in historical perspective by chronicling the entire history of cross-border currencies, from the invention of coins in the 7th century before Christ to the cryptocurrencies of today and the central bank digital currencies of tomorrow. Money Beyond Borders recounts how Greek and Roman coins became the first true international currencies. It tells how the Florentine gold florin became the greenback of the Renaissance and how it was succeeded by Spanish silver and the Dutch fiat currency. The book explains also why the British pound dominated the international economy in the 19th century, why the dollar rose to the top during World War II, and why the dollar has survived predictions of its imminent loss since the 1970s. The long history of international currency shows that the same factors that encourage their widespread use will eventually lead to their abandonment as well. Money Beyond Borders makes a powerful case that the dollar is now on the downside of this cycle, and it considers who the winners and losers will be when there is a flight away from the greenback. Barry Eichengreen, I think, hardly needs an introduction to this audience. He is the George Pardee and Helen Pardee Distinguished Professor of Economics and Political Science at the University of California in Berkeley. He's a research associate of the NBER, a research fellow of the CPR, and one, I would say, of the world's leading scholars when it comes to international monetary and financial history. He has published many influential books, and I think these books have shaped the way we think about global currencies, financial crisis, and the international monetary system. So it's therefore a great pleasure to welcome Barry Eichengreen, who's also, by the way, a SUERF Fellow, and he will present his new book today. Following his presentation, we are delighted to hear comments from Catherine Schenk, Professor of Economic and Social History at the University of Oxford, and a distinguished expert on international monetary history. Catherine, also a very warm welcome to you. And now, without further ado, Barry, the floor is yours.
Let me start by thanking SUERF and especially Jakob and Catherine for participating in this webinar and this presentation, but everybody involved. It's a pleasure to be able to talk for a few minutes about my new book. As one might say, this is not my first rodeo. I have written and spoken about international currencies before, but I was prompted to take another look by current events, but also by some opportunities to broaden the aperture, if you will, and take a much longer term perspective on the questions. So the current events that prompted me to revisit the prospects for the dollar as the currently dominant international currency were two. Number one, technological developments. We are in the age of cryptocurrencies, debates over stable coins, new payments mechanisms, including but not limited to distributed ledger technology, blockchain, in other words, an immediate realization as you begin to consider the global role, the cross-border role of currencies, is that technology is always developing, evolving, and changing the relative position of different currencies in the international domain. So I wanted to look at the role of technology in a longer term perspective from the advent of coinage in the 7th century BC, if you will, through the development of bills of exchange, bank money, right up to the present and potentially into the future. The other more mundane consideration, if you will, was Donald Trump, who began his second term, if you will, when I was hoping to finish the book, and that, of course, highlighted the role of politics and the role of institutions as well in international currency status. So the role of institutions and politics is the other theme, if you will, of the book, that international currency status has important political as well as economic and financial preconditions. So we economists and economic historians are familiar with economic and financial preconditions for the rise, extent, and eventual decline of international currencies, that currencies that are widely used across borders tend to be the currencies of healthy economies, if you will, that do a lot of, are engaged in a lot of commercial transactions with other states, kingdoms, etc. They tend to be the currencies of political entities that are engaged in international financial transactions as well, that have liquid financial markets that are open to the rest of the world. So those economic, commercial, financial preconditions, I think, are well known. I emphasize in the book as well the political preconditions, both domestic, both internal, if you will, and external. So internally, domestically, one sees, going back all the way to ancient Greece and Rome, the role for separation of powers, checks and balances, rule of law, coming up closer to the present, independence or autonomy, to use the historically more applicable term, autonomy for the central bank or the monetary authority. Internationally, one sees the role of alliance, of military capacity and alliance politics, that for foreign entities, political entities, currency to be widely used, the entity in question has to be able to defend its borders, repel foreign threats, and project influence internationally. So I emphasize the role of alliance politics going all the way back to the Delian League 2 millennia ago, but also up to the present, when there are now questions about the role of the United States in NATO and whether the US is still a reliable alliance partner. We know that central banks and governments tend to hold and use the currencies of their alliance partners, because their alliance partners are seen as reliable stewards of their reserve holdings, and holding and using the currency of that alliance partner is a show of good faith. It's an indication of appreciation, if you will, in the connections between security and finance. So those political themes obviously are intended to resonate with questions around the United States at the moment and the role of the dollar going forward. So as Jakob said earlier, I start with the advent of coinage in ancient Lydia, 7th centuries BC. I trace the role of Athens's owls and Alexander's in the age of the ancient Greeks. I trace the role of the Roman denarius its rise during the era of the Republic and its fall during the era of the Roman Empire. You mentioned, Jacob, how the Florentine florin is sometimes referred to as the early modern greenback. It was really the Byzantine solidus that Robert Lopez, the Yale historian, referred to as the dollar of the Middle Ages. All of this is designed to indicate that there is a long history of use of currencies of dominant economies with extensive commercial and eventually financial links with other states and continents, a long history of their cross-border use. You could have well mentioned the case of the Dutch guilder, which was arguably the first fiat currency after redemption of Bank of Amsterdam money into specie, was limited in the late 17th, early 18th century. I look at the transition from the guilder to the pound sterling, which you also mentioned, and then the transition from the pound sterling to the dollar. So the dollar's history is especially rich and timely. It's a reminder, I think, that again, that international currency status has important preconditions and institutional and political as well. So in the United States, there had been and still is deep and abiding suspicion of concentrated financial power that translated into the absence of a central bank to act as a lender and liquidity provider of last resort to U.S. financial markets from the 1830s up until the eve of World War I, explaining in large part why, despite the fact that the U.S. became the largest economy in the world circa 1870, the dollar played no international role until the 1920s, partly because of the absence of a central bank to backstop U.S. financial markets. So it took some conscious financial and political engineering by the likes of the German-American financier Paul Warburg, who campaigned for a central bank, in large part to internationalize the dollar, to foster markets in dollar-denominated trade credits for U.S. exporters and importers who previously had to go to London, had to have their bank engage with a correspondent bank in London in order to source sterling-denominated trade credits, which Warburg regarded as a handicap for U.S. business and finance. And it was partly at his volition that the Fed was, he was present at the famous meeting on Jekyll Island in 1910, when the outlines of the Federal Reserve System were developed and leading to the Federal Reserve Act of 1913. So the dollar then has this interesting history when it emerges as the dominant international currency twice. Once in the 1920s, when it became co-equal along every dimension, really, to the pound sterling, a status that was then lost in the 1930s as a result of three devastating banking crises in the United States. And then the dollar became the dominant international unit, of course, a second time after World War II as a result of the Bretton Woods agreement and the emergence of the United States as the only economy with deep and liquid financial markets open to the rest of the world. So that checkered history, if you will, I think sheds light on the prospects of the potential rivals to the dollar now going forward. The rivals most people think about, of course, are the currencies of the other large economies, the Euro area and China. And I think the dollar history that I just recounted is a reminder that despite the questions people now ask about the prospects for the dollar going forward and whether there could be a crisis of confidence in the dollar for political reasons, for economic and financial reasons, chronic U.S. budget deficits and explosively growing debts, the possibility that the euro and the Chinese renminbi could develop into serious rivals for the dollar, that possibility is not to be taken for granted because there are political, institutional, as well as economic and financial preconditions for more widespread adoption and use of those currencies that are not to be taken for granted. So everybody knows what the euro area, what Europe has to do in order to foster more widespread cross-border use of its currency. It has to complete capital markets union in order to render markets in euro-denominated assets more liquid. Success there is not to be taken for granted because banks which are national champions push back against more banking system consolidation and more widespread cross-border banking. Fund managers in Luxembourg and Ireland push back against the establishment of a more powerful euro area financial regulator. Europe has to create a larger stock of safe assets, AAA rated government or European Union bonds. As a matter of financial engineering, we know how to do that. As a political matter, there is resistance to giving that additional power to the European Union and earmarking more national government revenues toward servicing those bonds. And if you look at the history, the state or federation or political entity in question having a common defense and foreign policy is an important correlate of international currency status. Europe has realized in light of recent events how important it is that it is important to be more self-reliant in a security sense, as well as a financial and monetary sense. But as Mario Draghi reminded us a year or so ago, Europe continues to produce 11 different varieties of tanks, and who knows how many different kinds of drones, rather than moving toward a common unified defense posture. So again, that's a reminder that the will may be there, but the politics and institutional prerequisites will take time to complete. I would argue that the political and institutional obstacles to renminbi internationalization are even more formidable, if you will. It's important. Everybody talks about the growing international role of the Chinese renminbi. It's important to remember how far behind the dollar the renminbi remains. So the obvious statistic is that the dollar still accounts for some 57% of global foreign exchange reserves. The renminbi accounts for exactly 2% of global foreign exchange reserves. And if you look at turnover in the foreign exchange market or cross-border, the value of cross-border payments, the disproportion is really the same. It's explicable by the fact that the United States has been at work internationalizing the dollar for more than a century. The Chinese have been internationalizing the renminbi for barely a little more than a decade. So they have a lot of catch up to complete. the catch-up is now slowing because the Chinese economy has slowed from the double-digit growth rates of the early 2010s to barely 4% GDP growth rate today. And if you look at cross-border payments completed through China's cross-border interbank payments system, CIPS, their volume has similarly slowed to the low single digits from double digits a few years ago. So my view would be that nothing in China is going to grow at double-digit rates going forward, given demographic headwinds, etc., and that includes cross-border use of the renminbi. And then there are those political preconditions for successful currency internationalization. Everything that I implied about political challenges to the dollar going forward, questions about rule of law, a separation of powers, political checks and balances in the United States applies with a vengeance, if you will. In China, the People's Bank of China is not an independent central bank, and those political obstacles to further renminbi internationalization will remain for the foreseeable future. So all of that renders me pessimistic about the prospects for either the euro or the renminbi filling the dollar's shoes, were the United States and the dollar to step out of that role, if you will. I think the euro and the renminbi can continue to nibble on dollar dominance on the margin. There are also non-traditional reserve currencies, the currencies of small, open, well-managed, generally inflation-targeting economies. Since Catherine is here, I will mention Canada as an example, but the list would include also Australia, New Zealand, Singapore, South Korea, the Nordic countries. Much of the ground that the dollar has lost as a reserve currency over the last couple of decades has been gained by the currencies of those countries, not by the euro, not by the Chinese renminbi. I think that will continue. It's likely that central banks of emerging markets that did not inherit a lot of gold from the past will continue to trim their U.S. Treasury security holdings and add to their gold holdings on the margin. So there it is the opportunity to diversify away from the dollar on the margin. But if there is a crisis of confidence in the dollar going forward, as I said before, there is no alternative to the greenback at scale to support cross-border trade and payments as we know them. So that leads me to the gloomy conclusion at the end of the book that a crisis of confidence could lead to a 1930s-like scenario. When we teach the Great Depression and the end of the first age of globalization, we talk about things like the Smoot-Hawley tariff and retaliation. Given U.S. trade policy, reminding our students of that history is timely. But the other factor that was at work in the 1930s was a crisis of confidence, first in the pound sterling. There was the liquidation of sterling reserves after the 1931 devaluation, and a crisis of confidence in the dollar as a result of the banking crises in the United States. So when sterling and dollar reserves were liquidated, there was not enough liquidity to support cross-border trade and payments on the scale they had occurred in the 1920s. And I fear that if there were to be, I'm not predicting, but I'm thinking about future scenarios, were there to be a crisis of confidence in the dollar, going forward, that could be a similar threat to globalization as we know it. So on that less than happy note, I'm happy to turn the microphone back to the two of you. Thank you.
Thank you, Barry. Very enlightening. Catherine, the floor is yours.
Right, so it's clear that this is another classic Eichengreen book. As he said, he's written a lot on the rise and fall of international currencies, really elevated, I think, the Great Depression and the international monetary aspects of the Great Depression into the zeitgeist and really into the foundation of how we think about the evolution of geopolitical as well as economic dislocation. So it's an excellent overview. As he said, he's kind of stretched himself out of a bit of a comfort zone and learned quite a lot about the Greeks and the Romans and 18th century Amsterdam, drawing on a range of established literature there. I think one of the big messages of the book is on international currencies that it's not a neutral sort of economic phenomenon. And it was in the sort of 2005s or so, 2004, people were thinking, oh, well, you know, where is the world going to go next in terms of international currencies? And what are the determinants of an international currency and whether the dollar or the renminbi or the euro would prevail? What we've learned since then, I think, is that there is a lack of sort of neutrality, that politics matters, institutions matters. And this is a key message, I think, of Barry's work. And also that military power matters, and he's established that in other papers about invoking sort of Mars in the determination of key currency status. And so he draws this out, as he said, from the Greeks and Romans to today. It's fashionable when you're talking about international money to sort of graft a national money framework into an international context. And this helps us, I think, understand a bit of Barry's argument. So we think of the roles of money as being the means of exchange, the store of value, the unit of account. And often these are then sort of mapped onto an international framework of being used in payments, being used in foreign exchange reserves, or being a unit of account in commodity trade. And so when Barry is addressing these sorts of functions, we link those also to network externalities, that to be an international currency, you need to have a counterparty willing to accept it, and people have to have confidence in their ability to use it. But also the liquidity, that you need to be able to get in and out of it seamlessly and cheaply. And in the store of value element of a national money, there's always the stable value or low inflation type of determinant. And Barry really skillfully shows us that not all these three determinants are equal. And for him, looking particularly at the long story of the US dollar has prevailed despite its kind of ups and downs, despite quite a lot of long-term and short-term changes in its external value, the long depreciation of the 2000s, through inflationary periods in the 1970s. And so he's arguing that it's the structure of the markets that is more important probably than the stable value. And maybe we can see this in the way that the dollar is used. So as he said, you know, the least probable use of the dollar, I guess, is as a foreign exchange reserve. So that's less than 60% of foreign exchange reserves are denominated in the US dollar. And this has been pretty stable, around 65% for quite a long time. But in terms of foreign exchange turnover, it's at least 90% of on one side or the other of all foreign exchange turnover, and maybe 70% of the denomination of payments, at least those that are denominated through SWIFT. So there is, if you like, a sort of a distribution of the international use of the dollar that I think reflects some of the driving features that Barry emphasizes in this book. I'd like to move along, sort of emphasize this role of the liquidity of the markets, of the usefulness of confidence in the ability to find a counterparty, and the network externalities. And again, I'd argue that this is not all market driven either. And this is underpinned by institutions. It's historically been very carefully managed through coordination, and particularly central bank coordination. So we have the movement from Amsterdam to London, and that's during the 18th century globalization. That's as a result of the sort of political fall of the Dutch Empire. And that seems sort of a traditional kind of story of moving to an alternative center based on the economic, political, and institutional frameworks available in London. But the next, and possibly the only other big transition, is from sterling to the US dollar. And here, that transition, he speaks about the interwar kind of movement. We saw in the 1920s the effort, as he's just described to you, of the Federal Reserve, the brand new Federal Reserve, to build a dollar money market based on acceptances. It turns out that wasn't as easy to do as they thought it was going to be. Almost all those acceptances stayed on the Federal Reserve's balance sheet. They don't never really get a secondary market going. So it's not just the collapse, the financial crisis that kills it off, but it doesn't really kind of take off in that sense. I'd say also that already by 1950, the US is using its dollar weaponization, I suppose, in its sanctions against China. So it suspends the use of the US dollar by all Chinese nationals unless they can prove that they haven't been associated with the Chinese Communist Party. And I think this is a really important episode. So when people think about the potential for, and Barry writes about this in his book, the potential for sanctions to undermine the use of the dollar, we need to remember that the use of the dollar in sanctions has quite a long modern history. And so we need to think about what's different now than then that might prompt a shift on that basis. He doesn't speak so much about, as I have, I guess, about the shift from sterling to the US dollar. He invokes Averro's idea of that it's sort of a zombie currency from the 19th century onward because of the decline of the military and international economic power of Britain in the global economy. I kind of think of zombie as not a very good metaphor for what happens to sterling. Zombies, they are the living dead. And in that sense, you can think that sterling kind of drifted on, but was essentially dead as an international currency because it seemed inevitable that it would decline. But zombies are also predatory, and they open up the skulls of living people and healthy people and eat their brains. So in a sense, I think that metaphor isn't quite as good as it could be. I think of more in the 1960s, 1950s, and 1960s, that sterling was in a sense a shield. And it was a shield to protect the international use and that of the US dollar, and to protect Germany and Japan from having to have their currencies be international currencies, which they didn't want to do because of potential vulnerabilities they perceived this would lend them. So there's a lot of very strong coordination and cooperation in order to support sterling's use as an international currency. Short-term credits among central banks. Eventually, Britain guarantees the dollar value of foreign exchange reserves held overseas. But there's also quite a lot of coordinated support to support the US dollar as an international currency. The gold pool, the swap network, and this sort of thing. So the coordination and cooperation during the pegged exchange rate regime, I think, is really kind of crucial. And it turns out they were right. Because in 1967, when sterling is devalued, 4 months later, the dollar is essentially devalued in terms of gold. So in 1967, finally, Britain has to kind of give up the ghost and depreciate sterling by over 14%. And in March 1968, the gold value of the dollar can no longer be supported, and essentially it floats free in the private market. And the official price of $35 an ounce is kind of a fake price that only central bankers use amongst themselves. So I think emphasizing this idea of sort of the management and the coordination and cooperation is an important element of the story that Barry's trying to say that I just wanted to highlight a little bit more. That coordination continues into the floating exchange rate regime era of the 1980s and the 1990s. So you have the Louvre and the Plaza Accords. In 2008, you have the central bank swaps, which feature, of course, in Barry's book to support dollar liquidity in the crisis. The last week, the G7 met and endorsed the OECD and IMF investigations to try to monitor and discourage global imbalances. So this and encourage those with surpluses to grow faster and spend more on Social Security and inflate themselves a little bit more, and those with more chronic deficits to do the opposite. This feels like a very 1960s kind of discussion. So it's interesting to see it come back again. So it was a discussion. The global imbalances were big in the run up to 2007. And they're big again, but it's also kind of a longer term story about the management and the effort to influence the international monetary and economic system. So Barry's talked about the renminbi and the euro, and I agree with him there. I might just pull out the fintech because I think some of the people online might be interested in that aspect. So private fintech, the potential for coordination and management of a fintech-oriented system of international monies is not a likely prospect, and certainly not as straightforward. These are private firms operating in competition and for profit. It makes us think, though, about, and there certainly has been a very rapid increase even since Barry finished his book, in the use of stablecoin and even crypto in payments, that kind of means of exchange. So we have the work by Graf von Lückner, Reinhardt, and Rogoff that maybe as much as 11% of Bitcoin transactions are using Bitcoin as a vehicle currency between two fiat currencies, which is a significant amount of a very large amount of transactions. And then more recently from the Bank of Canada, Friedrich and Giles' CEPR paper looking also at stable coins and trying to kind of think about not only crypto, but also stable coins and the geography of who's using them to settle and who's not. And both these people, these groups, they identify frictions in the payment system as an important driver, both capital controls, but also the cost of remittances. So the international money system that's operating now is full of frictions, and it's very expensive, and it's more expensive the less you want to send. So another maybe dimension of analysis for international money is the wholesale versus retail. And I've become very interested in cross-border payments in the last few years. And so has the G20 since 2020, and their kind of roadmap efforts to ameliorate some of the inequalities, the expense, the speed things up that is in the kind of global payment system. One thing I wanted to highlight is that the payment system and the structure of the cross-border payment system may also reinforce the use of the US dollar. So that's another institution we might think about. So CLS, the only place you can really do multilateral clearing, operates in 18 currencies, but it does kind of promote and shrink the access of a lot of emerging and developing economies from that kind of risk mitigation. So I think we need to think maybe a bit more. I've always been kind of very down on stablecoin and crypto as being a potential international money, and thought of it very as kind of a sort of a speculative home. I think things are changing now. And I think they've changed even since Barry has finished his book. So I'd really like to hear what he thinks about the prospects. Barry is most well known for, well, maybe not most well known, but certainly well known for his ideas about multipolarity and the ability of more than one international currency to be functioning in the system in different ways. And I wondered, I guess as a question, reflecting on having finished the book, I thought that fintech really, I think his word was that none of these options were ready for prime time. How he thinks prime time or the window of prime time is opening up a little bit more. Anyway, great book and very readable, and I learned a lot. Thank you.
Thank you very much. Barry, I give you a few minutes to reply to the comments that Catherine gave. Just a few minutes so that we have sufficient time for Q&A, please.
Okay, I will be disciplined. Catherine, thank you for that. Lots of food for thought. Let me touch on very quickly on 4 or 5 points. I like to think one of my contributions stemmed from work with Mark Flandreau was to highlight the emergence of the dollar as an international currency already in the 1920s. and not only after World War II. You raised the interesting question of whether I exaggerate the point or not. I think clearly a lot of the trade acceptances originated in the 1920s, ended up on the Fed's balance sheet, but there was also a secondary market. They didn't all end up there. And the reasons for the collapse of that market and trade acceptances in the 1930s was fundamentally political, not economic or financial. It was that Carter Glass, the representative and then senator from Virginia, took out after the Federal Reserve System, and not unlike how Donald Trump has taken out after the Fed more recently, and for political reasons, the Fed stopped supporting the acceptance market in the early 1930s. You are the expert, not me, on sterling after World War II. I have one footnote invoking Melis Avaro's PhD dissertation and article on sterling as a zombie international currency, and maybe we should prefer a different metaphor. I do think the coordination in support of sterling and then in support of the dollar already in the 1960s was important. And what I try to do in the book is to look at the international political foundations of that coordination. That in the 60s, it was heavily the Japanese and the West Germans who supported the dollar because of those links with security considerations. They relied on the United States we had boots on the ground in both countries, and they were disproportionately supportive of the dollar. As a result, I'm skeptical about scope for coordination around global imbalances, around the level of the dollar and the renminbi today, precisely because of political tensions. Finally, use of stablecoins and crypto. I'm skeptical for every Bank of Canada study you cite. I can cite a Kansas City Fed study which found that exactly 1% of stablecoin transactions in recent years was associated with actual payments, and the others were used for things like on-ramps and off-ramps to other cryptos. I think technology will shape the future, clearly. I agree that distributed ledger technology is important, but I think the future will lie not in stablecoins, but in central bank digital currencies and tokenized commercial bank deposits. And insofar as they open up new channels for payments and reduce those frictions you were talking about, they will weaken network externalities and open the door to more alternatives, more non-traditional international currencies.
Okay, thank you very much. Well, we already have quite a few questions in the chat, so I'll pick a few. And one of the questions that I found very interesting was about gold. If there are no opportunities, alternatives to the US dollar as a reserve currency, then the question, of course, is, will central banks increasingly, hold their reserves in the form of gold or not? So what is your view on that? Will the role of gold increase, in tandem with perhaps a further decline of the US dollar as reserve currency?
So I've been arguing that the importance of gold in central bank reserve portfolios and more broadly in financial markets should decline for a long time now, and I've been forced to modify my views slightly by recent events. My traditional argument is that if you want the diversification benefits and the inflation hedge that gold has traditionally provided, there are other financial instruments in the 21st century that can provide those same services at lower cost more effectively. But now there is an additional consideration, which Jakob, you alluded to earlier, sanctions risk. That is in part what is motivating central banks to add gold to their portfolios. The Bank of Russia doubled the share of gold in its foreign reserves between its annexation of Crimea and its attack on Ukraine, and it brought all that gold home to St. Petersburg and Moscow to insulate it from sanctions risk. So I think that is part of what is motivating emerging market central banks' uncertainty about the application of sanctions by the United States and perhaps others going forward. The problem, of course, being that if you bring the gold home, it can't be used for financial transactions. If it's warehoused at the Bank of England or the New York Fed, it can be lent, it can be used as collateral, etc. Not if you vault it at home. And the only examples we have of gold being used in cross-border payments involve countries like Venezuela and Iran, who have no alternative.
Okay, very, very clear answer. One of the questions that was also put in the chat by Nazar Cabral is, okay, we don't have the euro or the renminbi as an alternative, but what about if the BRICS team up? Can't they make a real competitor to the dollar as an international currency, both for transaction purposes and as reserve currency?
That's a big if. The BRICS are a very heterogeneous collection of countries economically, financially, and politically. Think about the euro area and the teething problems that the euro has had. It has made zero progress as a global currency, as a vehicle for cross-border payments in its quarter century of existence. And the BRICS, of course, are infinitely more diverse than the members of the euro area in terms of their economies and politics.
Okay, so that's not a viable alternative. Okay, there's another question by Willem Kooi. Willem, nice to be in touch again. He is arguing, or he's asking the question, how important it is to have a sufficient supply of safe assets. You know, that was one of the arguments that you put forward why the euro could not take over the role of the dollar. But how important is this really? Especially in light of financial technological developments. So how important is it that there is a sufficient supply of safe assets nowadays?
My conversation with central bank reserve managers, for example, suggests that it is still very important, that they think in terms of the liquidity tranche of their reserve portfolios. A substantial share of the reserves they hold have to be safe and liquid because they want their value to be predictable. They want to be able to use them. They want to know how much firepower they have if they need to intervene in the foreign exchange market or otherwise use their reserves. So they want to hold the liquidity tranche of their reserve portfolios in something that is safe and liquid. And I think other changes in technology notwithstanding, that remains the case. Another way of thinking, to return to an earlier question about the accumulation of gold by emerging market central banks in recent years, is they have excess reserves, more reserves than they need for prospective intervention in the markets. And those additional reserves, the investment tranche of their reserve portfolios, they can hold in stuff that's not as safe and not as liquid, including gold.
Okay. Then there's a question by Hideki Sato arguing or asking about the role of the euro-dollar markets in respect to the international role of the dollar. So how important was the emergence of that euro-dollar market for the continuation of the dominance of the dollar?
Catherine, that's a question for you, no?
Well, Okay, let's ask Catherine first, and then perhaps you can, if you disagree, you can share your views on that.
Well, so one of the sort of underlying features of the decline of sterling, and something else that I think is important to remember, is the separation between geography and money. And in this case, as the British Treasury imposed more restrictions on the use of sterling as an international currency in the late 1950s, so banks turned and started to use the US dollar in London, and that's the birth of the euro dollar market. So certainly, I think that increased the liquidity of these markets, the usefulness, as I said, of the dollar as an international currency. So it does enhance, I think, the growth of the international role of the US dollar from the 1960s through the 1970s and 80s, and it really becomes the kind of foundation of the international financial system, as well as the international monetary system as a result.
I agree with that. I would add that this speaks to our earlier discussion of sanctions risk as well. So there are different origin stories about the Eurodollar market, but one story has to do with the Soviet crackdown on Czechoslovakia in 1948, and the Russians' decision to move some of the dollar balances of Moscow Narodny Bank from New York to London, precisely because they feared that the U.S. might apply sanctions to them in the event of, I don't know, a future Soviet incursion into Hungary or whatever might come next.
I should say that historically, London as the dollar center then came under a lot of pressure during the 1970s and 1980s, when the United States was using a lot of financial sanctions and trying to weaponize the US dollar, and Britain did not follow. So Margaret Thatcher and others were very against using finance as a weapon of war, and this also kind of enhanced the attractions of London.
Anders Knaan also had a question about the role of artificial intelligence. You know, there's a kind of a race between several countries, US, China, EU, but with a tremendous lag, I think. So how does that affect the role of the international role of the dollar? Does it play any role at all?
So we do these webinars partly because we get unexpected questions that we haven't heard or had an opportunity to think about.
Once you have Ernest, you for sure get this kind of questions.
Well, so there are there's a debate, of course, of what the productivity effects of AI are going to be, and whether they imply that the U.S. economy, which is one of the AI frontier economy along with China, whether the US will grow faster as a result of the AI revolution. If it does, that can reassure people who are worried about the ongoing rise of the debt to GDP ratio in the US, and whether the US is flipped from one side of the Triffin dilemma, where we're not providing enough securities to the rest of the world, to the other side, where we're providing too many to remain consistent with confidence, the maintenance of confidence in the greenback. The productivity effects of AI, the jury is very much out. But if you're worried about the excessive growth of public debt in the United States, maybe you can take a little bit of reassurance from AI.
Can I chip in here as well?
Yes,
so I think there is potential for AI in solving some of the payments issues and cross-border payments issues, and it could get embedded in tokenization and other sorts of things, and sort of the even generative AI in time. I could imagine there'd be some functions that might be feasible for using it there, and I think people are thinking about that at the moment.
The other thing to think about in this connection, financial stability is important for the maintenance of global currency status, and more generally for the operation of the international monetary and financial system. And we've had some recent reminders of the possibility that AI could endanger financial stability. The US has a very permissive regulatory attitude toward AI. So where might these problems crop up? Worth pondering.
Okay. You know, when I listen to and when I read about the changes in dominance of a particular currency over time, then I always use the words critical juncture, like our friends Asimoglu and co-authors. And my question is, do you think at the moment Trump is creating such a critical juncture in the sense that, you know, I think there's a stronger tendency than ever before for European countries to team up and to try to, you know, create more unity because, you know, there's increasing recognition that, you know, the US may not be any longer the reliable ally that it used to be in the past. So perhaps unintendedly, Trump is creating what is needed for the euro to take over the role of the dollar.
I think it's clear that bankers, government officials, and others around the world, not only in Europe, but more broadly, are rethinking their dependence on the dollar, the US correspondent banking system, and so forth, and looking for ways to hedge their bets. Whether the aforementioned constitutes a tipping point, whether we're about to reach one, we are economic historians rather than prognosticators about the future. Who knows for sure? But there is a lot of skeptical chatter around the dollar. That chatter has intensified since Trump's second term began, since Liberation Day, etc., since the war in the Gulf. So I think there are reasons for concern. Whether they lead to a tipping point and when, no one knows.
Well, I think that's a nice conclusion of today's webinar. No one knows, but that's why we have to think about it and continue talking to one another. So let me take this opportunity to thank both Barry and Catherine for your excellent presentations and the vivid discussion. And also, I'd like to thank the audience for your interest and also for the several questions that were raised. I think we had a very good discussion about a very interesting book. So Barry and Catherine, thank you again. And having said that, I wish you all the best. Goodbye.
Thank you.
Thank you. Goodbye.
All right. Thank you.